Almost everyone knows about GameStop's return to meme stock status, but in this video I wanted to answer a question that had been bothering me for some time. What would happen if I opened a trade in GameStop at the worst possible price? Would even my long-term investing disciplines that I've honed since 1998 be able to save me from making the mistake of getting into a GameStop trade near its high? My name is Eric, my nickname is Irked, and I've been investing in stocks since 1998. Initially, I was going to open a trade in GameStop in after-hours trading when it was trading around $40 a share on Monday, May 13th, but I decided against it. GameStop as a stock goes against a lot of the different elements that I need in a trade, much less as an investment. So I changed my mind and didn't open a trade. But when I looked at the stock on Tuesday morning before the market opened, it was trading at nearly $80 a share after just trading at $40 a share the night before. And I thought, wow, this could actually be a really valuable lesson for both me and you, my audience. What would happen if I got into a trade at the worst possible time? So with GameStop trading around $80, I said, all right, let's do this. If you're going to do this right, that means you have to be a total degenerate, which means you have to use Robinhood's trading platform. We're not just going to trade in after-hours trading. We need to have access to 24-hour trading. The reason for this is twofold. One, the people who trade GameStop do it that way. But two, we need more volatility. And the only way we're going to get that kind of volatility is if there's very little trading volume. And the only time there's that little trading volume is in 24-hour trading. I had a couple of key rules that I needed to follow. For one, this is a trade, not an investment. Like I said earlier, GameStop as a company is just in a deteriorating environment. It has not yet done anything to change its business model. And it's not going to be too long before games are delivered entirely digitally and not in a physical format. Therefore, GameStop cannot be an investment. In fact, it can barely be a trade because we're just trading on the emotion and sentiment of other traders. Number two, the way I protect myself is by risking money that I can afford to lose entirely. And as you see throughout this video, I will have planned in advance what the maximum loss I'm willing to risk is in GameStop, even though I used incredibly small quantities to start. The key discipline here is you should never think about how much money you can make. You should only think about how much money you're willing to lose entirely. Next, even though I knew I was making a mistake intentionally by buying near GameStop's high, I had to plan the entire trade in advance. I do update my plans as things change, but I need to know exactly what I'm going to do if I get into a trade and it just goes straight to zero. The next trick is to only use limit orders. The reason for this, especially in environments of low volume, is that all the different sell orders that are on the order books could disappear. And if you put in a market order at, say, $70, it's quite possible GameStop could briefly trade as high as $90, $100 or higher because you placed a market order, which means you'll buy it at any price. Somebody could put in a limit order to sell GameStop at 100. All the other sale orders could get cleared and you could get filled at 100 only to have GameStop trade at $70 on the next tick. Because of this, you have to use limit orders. Limit orders tell your broker that I'm willing to buy GameStop at $80 or lower, but I'm not willing to pay any more than that. So you can give me a better price than I'm asking for, but I will never get a worse price. I just won't get filled. I made my first buy on the morning of May 14th at $75.05. And again, this is why limit orders can be so valuable. I told Robinhood that I was willing to buy it at $80, but I didn't get filled until it pulled back to $75.05. On this chart, the blue bars that you see are extended hours trading, but the orange bars are 24 hours trading. So this trade that I executed to open the position happened before even extended hours were operating. In addition to making my first buy order, I also placed another buy order to fill if GameStop sold off to $60, which it did extremely quickly. And that order also filled on the 14th. This buy order lowered my cost basis to $70.03, so I immediately turned around and placed a limit sell order in case GameStop bounced higher, and it did. I didn't care about making any real profit. What I was looking for here was to limit the amount of exposure I had and to lower my cost basis from $70.03 to something simple, $70 even. So my sale order also filled before the market opened at $70.10, and that left me with a cost basis of $70 even. Now, I planned this entire trade in advance, and if you've watched my previous videos, you know how I do it. I look at a stock chart over the past and I find levels of support and resistance. The levels of support are where I put buy targets, and the level of resistance is where I put sell targets. In this case, many times in the past, GameStop had found support around the $40 level. So I made a limit order at $40, which filled during regular trading on the 14th and lowered my cost basis down to $55. With the cost basis at $55, I turned around and put a limit order at $56.50. This would knock 50 cents off my cost basis. And again, this wasn't about taking profits. This is about risk mitigation. With GameStop being as volatile as it is, it was imperative for me to keep my quantity under control so that I would limit my risk. Additionally, this sale also lowered my cost basis down to $54.50. Over the next couple of days, GameStop started to lose steam and sold off really dramatically. Now, I knew that GameStop had the ability to sell off pretty substantially, so I didn't have any buy orders that were going to fill unless it dropped below $30, which it did on May 16th. My next buy order, my fourth buy, filled at $28.70 on the 16th of May. And this buy order lowered my cost basis down to $48.05. However, if this was a regular investment, I'm already down nearly 50%. As you can see, GameStop dropped all the way down to $20 and stayed there. And it wasn't until Roaring Kitty came back and posted another tweet that GameStop really took off. And at that point, because we were so below my cost basis, I decided to throw a little bit more money into it on May 28th with my fifth buy, which went through at $21.55 and lowered my cost basis down to $42.75. You can see that during after hours trading, GameStop briefly popped up to $46, but I didn't have a limit order that low, so I didn't get filled. And it rolled over once more, selling off below $30. And this was where I made my next buy on June 4th at $26.25. This buy took my cost basis down to an even $40. And it was at this point that Roaring Kitty announced that he would come out and do an announcement as to why he was getting back into GameStop. I knew that day in particular was going to be extremely volatile. And I also knew that if he didn't say anything of real value, it was quite possible GameStop would sell off in a hurry. Accordingly, I was prepared to take profits before the day even came, with a number of different sell orders in limit orders in 24-hour trading that were placed all the way up to the all-time high at $80. Going into the event, my first sale filled at $45, and this took my cost basis down to $39. I was only trimming small amounts because I knew this was the catalyst that was going to make it so that I was going to be able to get out of this trade or not. Shortly after that, my next sale order filled at $50.40, which took me down to $36.15 as a cost basis. GameStop wasn't done rallying, and it went through my next sale order at $63, which now took my cost basis below that key $30 mark at $27.20. This was all happening the day before Roaring Kitty came out and did his announcement. That's how the meme stocks work. You usually buy the rumor and sell the news. So on the day of the event, as you can see, GameStop started selling off pretty substantially. Leading up to and during Roaring Kitty's announcement, they halted trading on GameStop several times. And when Roaring Kitty came out and said virtually nothing, that he was getting into GameStop just because he thought CEO Ryan Cohen might do something eventually, I knew it was time to close the position. So I made my final sale on June 7th at $39.10. And this ended up closing out the trade at 23.78% in profit. Now that's not much, given that over the time that I held it, GameStop more than doubled multiple times. However, you have to remember, I intentionally got in at the worst possible time. The moral of this entire experiment is all about risk management. Every time I get into any investment or trade, I know in advance that I'm going to buy in stages, sell in stages, and I know how much money I'm willing to risk entirely. This is the trading plan that I used when I initially made my first buy. And you can see I have every additional trade planned with how much quantity I'm going to spend and what price I'm going to buy at. Once again, I intentionally used the smallest quantity I could. When I made my first buy, I only bought 2 shares. And the reason I always buy 2 is I want to be able to sell one if the asset rallies after I buy it. Normally, when I make a trade, it is significantly larger than this. But since this was just an experiment and I needed to know how much money I was willing to risk entirely, and as you can see, if GameStop went all the way down to its all-time low around $10, I would be out $1,300 in order to be able to do the trade the way that I knew I needed to. You can see that I was going to buy in stages, and every time I was going to buy, I wanted to keep how far down I was to break even, under 40%, but that meant increasing the quantity at each lower and lower price. Now, I tend not to use stop losses. Instead, I manage my risk by knowing exactly how much money I'm willing to lose entirely. And as you can see, that total amount was going to be around $1,300, even though I started with $150. And you can see how quickly I can mitigate my risk. This is a picture of the trade planner after I made that sale at $70.10 on the start of the trade. And I went from risking over $1,300 to taking that risk amount down to $800. After I made that sale on May 14th at $56.50, my total risk was taken down from $800 to $379. It's important to remember this was not a real investment or trade. So my goal here was to get the experiment to risk as little amount of money as possible. So I kept taking profits in stages as I could. Once Roaring Kitty came back on the scene and GameStop started to get very excited in terms of volatility, you can see that I increased my risk a little bit up to $435 going into the day of the event. However, by the time I made that sale during the day of the event at $63, I had taken my total risk down to $176. Once again, this was a trade where I started by being prepared to risk $1,300. And by the end of the trade, had taken that risk to $176. Now, after GameStop sold off after Roaring Kitty's announcement, I decided that I was going to take some of the profits that I had taken off and put them back on, just the profits, no real capital, so I could have exposure in case GameStop ever took off. I made a buy on June 12th at $26.20, and this leaves me with a cost basis of negative $9.50. Instead of this trade costing me anything to have this share on the books, it adds $9.50 for that one share to the bottom line of the portfolio, in addition to whatever the current stock value is. If GameStop ever goes to zero, this trade will still be profitable. It will have made me that $9.50. However, if the meme stock mania returns, I'll be able to hang on to that share and potentially sell it for $65 or $80 to the next person who decides to go into GameStop at $80 a share. If you want to learn more, check out my blog, getirked.substack.com.